Hello and welcome to the fastest 4 minutes in finance. Well, as good as January was for the stock market, February was equally as bad. The S&P 500 index rose more than 5% in January, but was down about 3.7% in the shortest month of the year, driven down by those higher than expected inflation numbers from January and the continuing specter of longer than expected interest rate hikes by the Federal Reserve. But while inflation and interest rate hikes dominate the headlines, we're focusing on this week's Fastest Four on a piece of economic data that doesn't get a lot of headlines. This week, we're talking about the LEI. That stands for Leading Economic Index. And if we're looking to see where the stock market is headed, we need to look ahead, not backward. The Leading Economic Index is an aggregate of 10 economic and market indicators, including interest rate spreads, new business orders, building permits, manufacturing new orders and hours, and unemployment. The index declined 0.3% for the month and 5.9% year over year. That was a slight improvement from the one-year change the previous month. The LEI was down 3.6% over the 6-month period from July 2022 to January 2023, and that's a sharper drop than the 2.4% decline the 6 months prior to that. So the easy takeaway here is that the U.S. economic engine is slowing down. But the harder takeaway is how will the stock market respond to it? Now you could argue, as we have, that much of the poor stock market performance over the past year has been due to the market pricing where we are headed. But we've been saying for months that the first half of 2023 will likely continue to be volatile as investors pay close attention to every piece of economic news released. That news is volatile in itself. Bad news one week, good news the next week, and sometimes the good news is perceived as bad news and the bad news as good news simply because of market expectations. Well, now back to the LEI and how those numbers could impact markets. A quick warning, we are about to dive deep for a minute here. There's an interesting chart from LPL Financial that shows us that weakness in the LEI at roughly the current level has signaled near-term risk for markets, but longer-term growth. Take a look. The two lines of the chart are the 6 and 12-month market expectations based on where the LEI is. The gold line is the next 6 months. The blue line is the next 12 months. The blue box shows where the LEI currently is, the range of it. You can see the near term of 6 months indicates a pretty flat market from here. But if the LEI dips another percentage point or two, the 6-month outlook is much more favorable as long as it doesn't get much worse from there. And that would likely mean a deeper recession if it did. The 12-month outlook, though, is what I want to focus on. It's much better from here. The S&P 500 is up 8 to 10% 12 months following year-over-year numbers similar to the February LEI. Bottom line is this. It supports LPL's outlook and ours that the next 6 months could continue to be a bumpy ride in the stock market, but we could get less volatility and ride up in the back half of the year, giving us hope that 2023 could be a good year for stocks. Thanks for listening.